held companies. So I have quite a bit of experience as a financial executive, both in large corporations and in the role of an investor. So this is, on this slide, we're showing you a little bit of the overview of what we're going to talk about today. And I'll go through a few of the examples. As Ben mentioned, we are going to I think the thrust of this conversation will lead to some conversation of the two documents I sent. One is a security analyst report on the company, the Clorox Company, and the other is document is a set of financial statements from the Clorox Company. And what we're hoping to do is to give you a little bit of a brief understanding of how those are used in the fundamental analysis of a company and the value of its stock. Just to start off with, the basic premise of the conversation today is raising the question, have you ever wondered how an investor decides how much a stock should trade at? So you probably, with your familiarity and your interest in this group, you probably pull out the stock quotes every day, or you see them on the internet, and you see stock prices are at any point in time. And so the natural question is, well, what makes one company worth what amount and another company worth another amount? And why does that value change every day? So, I mean, the very broad answer to that question is that price of a stock is determined in an active market. That means where we have willing buyers and willing sellers, and they seek to trade. The stock trades at the value that somebody is willing to buy it at and somebody is willing to sell it at. And once we have an agreement on that, that determines the price. But the real question sitting back on that is, okay, when we have a willing buyer and willing seller, how does each of them know and understand how much they would be willing to pay or to receive in the sale of a stock? So they must look to some sort of financial parameters to understand how much that value that share of stock should have, and therefore how much they're willing to pay for it or how much they're willing to receive. And we're hoping to give you at least a little bit of exposure of how that process, or how people in the trading of stocks go through a process to determine that. So let's talk a little bit about who generally just guides the price of the stock. Now, I know each of you have probably looked at the stock market. You may do a little trading yourself. Your parents or other relatives or friends may do trading in the stock market. But it is true that most of us, when we are trading as individuals, are usually trading in relatively small portions of the stock that is actually traded in the stock market. So as much as we would like to, as individuals, have a great deal of influence on the value of a stock, it's not likely that our small trades are going to influence the price of the stock very much. So we tend to be, as individuals, followers of the stock price. We have to kind of take the price that the stock market offers, but the groups that are determining how much that stock should trade for tend to be the ones who influence the larger trades. And I've separated here, this is a very broad generalization, but two of the major leaders of those would be institutional investors, for instance, pension funds, mutual funds, or insurance companies. So groups that tend to buy or sell large pieces of stock tend to do the analysis on their own to determine what a stock value should be, and then they go into the market with that knowledge and trade based upon their expectations of a stock. So they tend to be very sophisticated buyers and very influential because of the size of the trades that they make. The other group, which is sort of overlapping, but is what I'd call securities analysts. And each large investment bank, so some investment banks, you may know that that are associated with brokerage firms like Charles Schwab or Morgan Stanley or Merrill Lynch. They tend to have analysis arms in their analysis departments in their group, and these are people who are very well versed in financial analysis and learn quite a bit about the companies, and they look and evaluate a company's stock and come to their own conclusions as to what the value of the stock ought to trade at, and they use that information to provide guidelines to their clients. So if you have a brokerage account with one of these investment banks, you would be able to receive the reports from these analysts and use that in your own for your own trading to determine whether stocks are trading at a good value or not a good value for your purpose. So, so what we're going to try to give you a little hint on today is what is the basis that these securities analysts use for determining the stock value. So now I'll tell you, we're going to be here for an hour, maybe more. This is a conversation which goes very, very deep. There are entire degrees that are issued and careers that are made around that question itself. So to learn all of the aspects of stock valuation takes many years, not just an individual session. But what we're hoping to do today is give you an introduction of the elements, some of the elements that go into that fundamental analysis, and where to receive some of this information so that you could go in and begin to look at some of this reporting and, to companies that you might be interested in, start to read the reports that are put out by the company or reports that are put out by the analyst. And based on that, begin to build your understanding of how the stock market looks at value in the companies that you might be interested in. So this is going to be, hopefully out of the end of this, you'll see a couple of these pieces of these reports, and you'll be able to pursue and seek out some of this information and begin to read it on your own, and over time build an understanding just by the communications that come from these groups of what the stock market is looking for the value of stock. So as I mentioned before, you've received two documents. One of them is the Securities Analyst report from Citibank on the Clorox Company, and the other is a set of financial statements from the Clorox Company. But let's talk a little bit about when a securities analyst sits down and begins to perform what we call fundamental analysis. Fundamental analysis is gathering all the data that would be relevant to valuing a stock and making an investment decision, and putting those pieces together to determine an investment decision and evaluation for that stock. So what are the broad inputs that they look to for that? First of all, they look to and just understand the company. How large is it? What are the products? What industry does it operate? And what does the management look like? How well is it managed overall? Then the next important piece for valuation is to look at the company's financial statements. And for some of you, I would imagine this isn't the most interesting thing to look at when you're looking at it out of context. So maybe you haven't spent a lot of time in the financial statements before. But the company's financial statements provide a lot of the key inputs into determining how a company should be valued. And once you understand what the language and what those financial statements include, the more relevant those financial statements are, and the stronger connection you'll see between the company's financial information and how the stock is going to be valued. Now, all companies, when you look at the stock market and you see companies are listed, all companies on the stock market are called publicly traded companies. So they aren't privately owned by individuals. They're publicly owned by people who buy stock on the stock market. All of those companies must file reports with the Securities and Exchange Commission, which is a branch of the federal government, which oversees and regulates the stock markets and companies that trade their stock on the stock market. So the best place to find financial information about these companies when you want to review them is, one, you could either go to the company's website, and you'll often see there's usually a section that says on their website called Investor Information, and within Investor Information they will have like their annual reports that they filed, and you could receive a copy of their annual report off of their website, or you could go to the Securities and Exchange Commission, the SEC's website, and there's a section called Edgar Filings, and Edgar Filings is the database that includes all of the financial statements that have been filed publicly by each of these companies that are listed on the stock exchange. So you could get from the Edgar Filings either the company's quarterly report, which they call a 10Q, Form 10Q, or an annual report, which is called a Form 10K. And it includes not only financial statements, but a great deal of information about each of those companies. So financial statements are a critical part. Then beyond the financial statements, there are a few other pieces of information the securities analysts will look at as they're evaluating the company. For instance, they'll look at not only how much money what were your revenues and profits of the recent years were, but they look at what's been your recent growth and what's the expected growth, because a high growth company may be worth more than a company that is not growing as much. So understanding the growth trajectory of a company is very important. The next input is the current financial market in general, because sometimes, as you know, we watch the day-to-day news, and some days the stock market as a whole is depressed. Some periods of time it's operating at very high levels. So how the stock market is looking at any point in time will also have an impact on the value of the companies that are trading within that market. So understanding the current financial market is a critical input. And then another important piece is what I call peer group and industry sector analysis. Is when an analyst is looking at an individual company, they will also look to other companies that are operating in the same industry, because investors, for instance, today we have the Clorox Company, and most of you have seen Clorox bleach and Clorox cleaning products and so forth. It operates in what we call the consumer products segment, and there are other consumer products companies, and investors tend to look at those consumer product companies similarly, so they would expect similar attributes in how stock is valued between one consumer products company and another consumer products company. So understanding that industry sector is an important part of that input. Okay, I think I've already touched upon this, but a little bit is where you can get the financial statements. One is the company's websites, and the other is in the SEC's webpage. Then the question is, where do I get a securities analyst report? Today you've received one from Citibank. For the most part, the best place to get a securities analyst report is if you or your parents or your friends have a brokerage account. Oftentimes, securities analyst reports are available to those people with accounts online. So to receive the Clorox report here, I just went on to my own account within Citibank. I searched within a section in the webpage for analyst reports, and I found the Clorox Company without any problem. Now, you won't necessarily find a securities analyst report for every company that's listed on the stock exchange. So if you hear about a company and it sounds interesting to you, there may be times where it's very difficult to find. One, you may find that every investment house does not follow that stock and perform a securities, an analyst report on it. So it may be followed, that company may be followed by certain investment houses, but not all of them. And then there are some smaller, or what I would call thinly traded stocks that don't get a lot of attention in the stock market, where it's just not worth the time of these investment houses and the securities analysts to prepare a report on those. So you shouldn't be surprised if in all circumstances you just can't find the securities analyst report. It tends to be for more actively traded companies. So let me start a little bit on just talking about the company we're going to look at today. And I purposely took a company that I think most of us could relate to, because it's a company that creates things that are very commonplace in our life, and that is the Clorox Company. And the Clorox Company, as you can imagine, you've been down the aisle of the cleaning products at the grocery store, or you've been in your own house, and their name comes after their flagship product, which is the Clorox bleach. And then they have a number of cleaning products that are related to Clorox bleach, or maybe have bleach in them, but they also produce a number of other consumer products that are well known, like Fresh Step cat litter, Kingsford charcoal, Hidden Valley Ranch, salad dressing. So they're sort of a broad-based consumer products company. So it's very easy for us to relate to what this company is. They manufacture products, they market those products, they advertise them where we see them, and they sell those products to us. So so at least it's something that we can all get our arms around, the type of company that is very intuitive to us. So we'll be looking over both some of the current financial statements as well as the securities analyst report there. So now I'm going to ask you, and I'll flash up some screens here, but you won't be able to read the details on the screen, so you'll need to look at your reports that you've received. But I want to walk through some of the financial statements, and the point is there's a lot to learn. Financial statements have a language to themselves, but I want to at least give you an understanding of financial statements, what's included in those financial statements, and give you an idea of how a securities analyst goes and looks at certain aspects of the financial statements of a company and uses those in the stock valuation. So, and you could even see, if you took some time after this, if you look at the analyst report and how they've done their work, you could see the numbers, how they've come right out of the financial statements of the company. So the first set of financial statements I want to look at is the consolidated statement of earnings. And the consolidated, let me just walk through this a little bit, but basically this is also what we call the income statement. So it's how profitable is this company? How much money did it earn from what were its total revenues, what were its costs that they incurred, and what were the profits that were left in that company after paying all of its expenses. And you can see the consolidated statement of earnings or income statement here includes all of that information. So you'll see as we look down, start at the top upper left of this financial statement, there's some very important information that comes out here. First, we have 3 years of financial statements, 3 years of income statements, and each of these is for the years ended June 30th. So an income statement covers a period of time. So it's saying, I'm looking at the consistent period of time, this is time, it's for a fiscal year. Clorox Company uses what we call a fiscal year financial statement. So rather than reporting on a calendar year like 2020 or 2019 or whatever, their fiscal year ends on June 30th rather than December 31. So each of these years is reporting on 12 months, but all of those 12 months are ending on June 30th. And that's the fiscal year that Clorox Company has chosen as its fiscal year and chosen to report its information. The second thing is, you'll notice these numbers are only 4 digits. So the Clorox Company certainly took in more than net sales of $6,721. And that's because, there's no sense in going down to the last penny on these financial statements, because it's really the largest numbers in their results that are the most important. So rather than reporting in individual dollars, these are all reported in millions of dollars. So that is telling us that if it's millions of dollars, that means if you look at the first line here, net sales of 6,721, that 1 at the end of that is 1 million. So that means the sales that we're reporting on here are actually $6,721,000,000 of sales that they had for that period of time. So when you see on here, sometimes companies report in thousands, sometimes in millions, but the millions means that the smallest number on in these documents, the smallest digit is that is in that denomination, so it's $1 million, and we would see this as $6 billion. The next line on there is costs of products sold. So this means this is what it takes for them to manufacture the product that they sold. So if they were selling only Clorox bleach, they would go out and manufacture, they buy the raw materials, they would run a factory, they would do all these things, and at the end, they end up with a bunch of bottles of bleach, and this is how much it costs them to produce all those bottles of bleach. And so with the first measure of profitability we look to is what we call gross profit. It's just, what did I sell it for versus what was the direct cost of that product? So gross profit is often something securities analysts look at closely in the company, and you can see that Clorox earned in the last year about $3 billion of gross profit on its sales. Then the company incurs a bunch of other costs to run its business. They have selling and administrative costs, advertising costs, research and development, and so forth. And and after I take all of those costs, my earnings come down to $1,185,000. And then of course I have to pay income tax on that. So my net earnings are down to $939 million off of my $6 billion of sales. So all of this information will become incorporated into the analyst report. And the next line is a very important one too, because it is something that you'll begin to use as you're looking at the value of stock, because the securities analyst looks at that and says, well, okay, well, that's what the whole company made, but I'm going to value one piece of stock, one share of stock. How do I value one share of stock based upon all these aggregate earnings? So they come down and on the bottom and they look at how many shares are outstanding of stock. And in this case, they are expressed in terms of thousands of shares. So this tells us there are 125,828,000 shares of stock outstanding. And in the end, that produces an earnings per share of $7.46 per share. So if you own a share of stock, your proportionate share of the net income of that company would be that amount of earnings per share. And that'll be an important measure as we get into the securities analyst report. Okay, I'm going to turn now. Now, another thing the securities analysts look at, and it's a very important financial statement for a company, is its balance sheet. And the balance sheet basically says, at a certain date and time, what are all the resources the company has? Its cash, it's money that's due to it, it's inventory, it's factories and everything. How much do they have? How much is all that worth? And how much money do they owe to other people in terms of its liabilities? And then what is its net, what we call net shareholders equity, the amount of assets minus liabilities. So in effect, a dollar value of the net assets that are owned by the shareholders. So you can see on this consolidated balance sheet, the first thing we notice is that this says as of June 30th, because balance sheets are measured. This is June 30th is the last day of their fiscal year, but a balance sheet is expressed as of a single day or point in time, meaning this is what the assets were on that day, the last day of its fiscal year. And these again are expressed like the income statement in millions of dollars. So as we walk down the financial statements, you can see that it has cash and equivalents of in fact, $871 million of cash in the bank. And it has receivables, meaning these are amounts that companies owe Clorox because they bought their products and they haven't paid for them yet. So Clorox is due cash of $648 million from those people. And then they have inventories, being unsold product, that are worth $445 million. So as we go down, they list all of the assets they have, which are potential resources they have that will eventually be turned into cash and available to pay their liabilities. Then on the other side, we go down to the section called Liabilities and Stockholders Equity, and we see that they have a number of liabilities. For instance, they owe accounts payable and accrued liabilities, means that's just bills they have to pay to the companies that they've bought raw materials from, and they still haven't paid for those raw materials. And then long-term debt means it's money that they borrowed from banks or other places to run their business. And so you can see there are a number of liabilities, and we come down to total liabilities of $5,300,000. And then we get to a stockholders equity section, and I'll ignore some of the details on here, but you can see stockholders equity in the total line there is $908 million. That is equal to their total assets minus their total liabilities. Total assets of $6,213,000 minus total liabilities of $5,300,000 means that they have net profits our net equity that's owned by their stockholders of $908 million. And you can see the reason this is called the balance sheet is you could see the total liabilities and stockholders equity of $6,213,000 equals the total assets, because and these have to always be in balance. They have to equal each other. So because net equity equals total assets minus total liabilities. So balance sheets are always in balance. The next page, and I won't go through too much detail on this because again, it's quite there's quite a lot of information that takes a while technically to understand here, but this is the statement of cash flows. So it's a little bit like the income statement in that income statement says, how much profit did I earn at the end of the period of time? This looks at it and says, well, I want to look at pure cash, and I want to know, is this business generating cash over time? And again, this is for the years ended June 30th, so it's on their fiscal year basis. But you could see, if you look closely at this, there are several sections. Top section is cash provided by operations, and this just says, hey, once I sell my goods and pay my bills, how much cash is coming into my operations? And that's in 2020, they've received cash of $1,546,000. The next section is investing activities, and it said, okay, well, of that cash flow, I made investments of capital expenditures, which means I've built factories and things like that. I spent $252,000 on that. And then down below is financing activities, which means how did I use my cash, receive or use my cash, either for my debt or for my stock. And you could see that they paid down $396,000 of debt, but they borrowed more, $492 million of debt. And then they've actually paid dividends of $533, meaning these are dividends or monies that they've sent out to owners of the stock in the form of dividends. So it's a way that their shareholders have received cash from owning their shares. So this is just, again, there's a lot of technical detail on there, but the cash flow statement is something the securities analyst looks to because it just confirms to them that there's actually cash moving and profits turning to cash and cash going into shareholders' pockets is an important way of measuring the value of that company. Okay, so I know there's a lot to digest out of all of that. But so that's a very high-level view of the financial statements. If you actually received a copy of the report, their annual reports, they include much more information than just the information that's on the financial statements, including a lot of narrative about the products of the company and the prospects for growth and things. So it is, the financial statement or the annual reports are easier to read than just reading the financial statements, and it puts a lot of this information into context. So you might want to pull up an annual report of your favorite company and look through it and then sort of try to connect their financial statements to the story of the company. So the next thing I want to talk about is the analyst report that's prepared by Citibank here. So Citibank, like us, has done a couple of things. As the securities analyst who has followed Clorox has received the annual report of the company, and it probably has also had a meeting with the company management where they sit down and ask them a series of questions so they understand the components of the company's performance and its growth prospects. And then they prepare what this is an update of their view of the prospects for this company. So if you want to turn to the first page, and here's the first paragraph, but I also want to focus you, if you look at the report itself, this is the first paragraph of the summary, but before we even get to that, to the right of this on the securities analyst report, first page, there's a little box that starts with the word neutral. And so it says neutral to, and to some extent, these first few lines here are the securities analyst's recommendation with respect to this stock. And at the time this report was issued, the stock price of the Clorox stock was $231.96 a share. So that's the current price for each share. So after digesting all of this information, and we'll get into this, how they've done that in a minute, but after digesting all this information, the securities analyst has come to the view that, I think this stock in a very short period of time should really be trading at about $246 a share. If I look at conditions of the current market, I look at the other companies in this industry and so forth. So in effect, they're saying this stock is about 5% undervalued. It should be trading for $246 and it's only trading for $232. So it is a good value at the current price. Having said that, in the first line there, it says its recommendation is neutral. And basically, a securities analyst will really, and sometimes they use slightly different nomenclature on this, but they will usually come up with several assessments. One of them could be a buy, meaning they recommend you buy this stock right now because it's significantly undervalued. It could be a recommendation of sell, which says, we think the market's valued this higher than it's really worth, or it's really reached its peak. You may as well sell the stock and put it in something else that has a higher prospect for growth. Or in this situation, a neutral rating, which is sort of saying, yeah, we think this is an okay stock. It's, you know, in terms of valuation, we like the company. We think it's going to provide some growth. But neutral says you could go either way. If you're really looking for some greater growth, go to a buy stock. But if you're okay and you just like the company, stick with neutral. So, and often that means that what they're saying is, well, if you own it already, maybe you just hold it. If you don't own it, I wouldn't necessarily buy it, but it is a decently valued stock. So you could see then, that's a lot of information in the first 3 lines there, that the stock is slightly undervalued and we have a neutral rating here. And you can see in the paragraph that we have on the slide here, and the first paragraph there, that the company goes through, the analyst goes through and sort of gives their reasoning for that. So, and they've said, hey, we've received their 4th quarter results, which means 4th quarter being the end of the fiscal year results. So, and then they've looked at the next year results for fiscal 2021. They've done their own projection, and they think sales are going to grow 3.5%. And they think the gross margin, the gross profit is, or the operating margin, the profitability is going to grow by about, by a slight amount to 19.5%. And that's going to yield, remember we showed you earnings per share on the income statement, that each share is going to earn about $7.66 a share. And then they give their prospects for 2022. And then their reasoning for how they've looked at the prospects for growth and increased sales for that company. And as a result, they've assimilated all this information and come to the view that, okay, and we don't show it here, but you can see it on the report. The next paragraph, it says, we're maintaining a neutral rating, although they did raise their target price a little bit to do $2.46. And they're really saying, hey, buy the stock now, or if you own the stock, wait it out, because it's going to be worth $246 a share. And when it gets to $246, maybe that's the time you think about selling it and putting your money in something else. So it's important. So you see, if this is the case of Clorox, but this is an important thing for, if you're starting to do fundamental analysis and you want to learn it, you want to see how Wall Street looks at the valuation of stock, get some of these reports and read what the analysts say and get their own perspective on what the growth opportunities are. Sometimes we look at a stock and we say, gee, I really like this product here. I'm going to go out and buy the shares. Well, the analyst will tell you whether, okay, well, you may like the stock, but it's already fully valued. So the stock market's already recognized the value of that stock. We don't expect the value to go up very much more. So even though you like the product, it may not be a great stock to buy, or they could come to the conclusion that, hey, we look at the value there and we think the stock market's missing something. There's a lot more growth potential in that company. We think that the stock is undervalued, and we think you ought to make that trade. So I would encourage you, think of some of the companies you're interested in and like to pursue, and get the analyst report, and then see what they have to say about the value of that stock. I just want to show you on the next page 2 here. Let's see. Okay, here's a page 2, and I won't go into too much detail, but I want to show you some terms that are in the Securities Analyst report that you're going to see a lot when you hear or read or hear radio analyses, or you watch television with some of the financial news channels, they use certain pieces of data to describe the value of companies. So this page here basically says, this is where the securities analyst has put the data from the financial statements into their own database, and then they've done some of their own ratio analysis. They've done some of their own math to come up with certain numbers that tell them whether the stock is worth more or less, just drawing that information from the financial statements. And I'll focus you on a few important pieces of data here, and I'm not gonna. It's a long and technical learning to get below some of these things, but it is important that you recognize some of the things here that the securities analysts look at very closely. So one of them here is what we call Ebitda. So Ebitda. So you'll often hear when somebody is evaluating, an analyst is evaluating stock, they look to Ebitda. Well, Ebitda doesn't show up on the financial statements. It's something that investors calculate about companies to help determine what the value is. And basically it means earnings before interest, taxes, depreciation, and amortization. So they've gone back through the financial statements and said, okay, well, what's the net income for this company? I'm going to add, and it's earnings before, so I'm going to add back any interest expense. I'm going to add back any taxes that they paid. I'm going to add back any expense, what they call depreciation and amortization expense. And I'm going to come up with this number. And you can see on the page, they call it an adjusted one, but they said in 2019, the EBITDA of the Clorox Company was $1,304,000. So that's a very important number that the securities analyst looks at to determine and do its valuation of the company. So it's just important for you to remember here that Ebitda, earnings before interest, taxes, depreciation, amortization, is a very important metric for the investment community. In fact, if you went to graduate school and were learning how to value companies, this would be a critical metric that you would look to. But I want to then turn over to the upper right because of this page, and there are a number of metrics that you'll often see quoted in the financial news on the company. And the first one is PE, and PE means price to earnings. So what it's saying is the securities analyst has looked at the current price per share of $231.96. And it's looked at the last year of annual net earnings or net income, and it's divided those two. And you'll often see price to earnings. If you looked at stock quotes in the newspaper or the internet or whatever, they often show price to earnings ratio. This is the most fundamental sort of piece of information that the stock quotes often include. And it is saying that, hey, if I earn, and you can see here the price to earnings in 2019 was 36.7. That means if their earnings per share were $1, the stock price would be $36.70. If it was $10, it would be $367. So it's just looking at the ratio between how much did that company earn in a given year and what's the stock price of that company. And they'll often use this to do a comparison of the value of this company relative to the PE ratios of other companies that are in the same industry sector, like the consumer products goods in this case. Or they might look at it at the rest of the stock market. And what's the rest of the stock market earnings? How much are the stock price is relative to the net income of that company for other companies. So, so that's a very important quick measure they look to determine whether a stock is overvalued or undervalued. And another critical metric on here is the next one, PB, which is price to book value. And you'll notice that the book value, when we look back at the balance sheet, you'll remember that the net equity of the company was $908 million at the end of 2021. And if you look at the top, just above this section at the upper right, there's a number that says market cap of $29,212 million. Market cap is a very important number. The market cap basically says, if I took today's stock price and I multiplied it by all the shares of stock that exist, this is what the stock market is valuing the whole company at, is $29 billion. And so it's worth $29 billion, but my balance sheet, which is, it says my stockholders' equity, which is what we call book value, it's the value that's on the books of the company, was $908 million. So if I divide 29 billion by that 908 million, this is saying, you can see at the end of 2020 that the price to book is 31 times. So the market value of that stock is 31.6 times the book value. It's worth 29 billion in the stock market, but the balance sheet says it's worth 900 million. So it's the multiple between what the balance sheet says and what the stock market says is the value of that company. So that's something that depending on the industry you're in, the securities analyst looks very closely at. Are we valuing that company how are we valuing that company relative to what its balance sheet says? So that's what I wanted to focus on at this point in time, but it is interesting, you know, as I said before, I would encourage you to gather these reports and go through and look at some of these comparisons, and then maybe even pull two companies that you think are in similar fields and compare some things like the price to book value and the price to equity value between the two of them, and see how the securities analyst has looked and valued those companies and has looked at those metrics. So I think at this point, that's giving you a little bit of perspective of the financial statements and the securities analysts and how those things tie together and where the stock market comes up with its valuation of the company, and in a way, how you could use that information to help you select what companies you think may be undervalued and therefore worth investing in. I just want to make one point on, Raul was saying earlier about the competition that's coming up, which has been very interesting. In fact, my daughters, who are graduated from college now, but were in one of these contests many years ago because they've been running them. And they're very interesting because it allows you to go in and do some of this work on your own to evaluate it. The only challenge with that contest is it's a very, very short period of time, 3 months. So there's a lot of things that can happen in the stock market that can affect the value of that stock in a short period of time. But that's what you'll learn as you get into that you'll pick a stock and there'll be things that information you know, but there'll be other events in the stock market that determine the price that make it very difficult to pick a value in a short period of time. Most of the analyst reports here aren't going to tell you whether this stock is undervalued for the next 3 months or 3 years or whatever. It may take a while for a company to reach that is undervalued to move from its current value to its full value. And that may not be realized in a full period of time. So sometimes the market moves slower than that 3 month window. So it's a much bigger challenge to pick the successful stock for a 3 month period than it is to pick a stock that is going to appreciate in value over a longer period. Okay, I think that's everything in our presentation. Do we
All
have?
right, so then we'll be moving on to our question and answer segment of this event. And so if you guys have any questions, please drop them in the chat right now and we'll answer all of them. All right, so our first question that we got was, what is the motive behind brokerages giving out analyst reports?
Well, the motive is, for the most part, that's part of the service they provide, and how they earn in effect, their fees that they receive from their customers. And that is one reason. The other reason is they are often involved in other aspects of um, and, uh, the investment world, like advising companies on mergers and acquisitions and so forth. So they often want to be the advisor and the underwriter. If one large company is looking to buy other companies, they look to the investment houses to be advisors to help them value those companies. So if an investment house has securities analysts who are an expert in valuing a certain business, they could use that information to try to get business in representing those transactions. But for the most part, it tends to be a service that they provide to their customers so that they can instill, provide advice that allows them to earn their keep, earn their fees with their customers. And that's a very good question.
All right, our next question that we got was, what resources do you recommend to help us understand these financial statements more?
Oh, that's a good point. There are other books that are interesting, and I'm trying to think. I have one now. It's called How Wall Street Works, and it's an interesting book because it takes and there's a couple books that have a similar title, but this has been around for a while and is constantly updated. It's a very thick book, but it goes through and it shows how information is used by Wall Street out of financial statements to identify undervalued stocks. So that's just one of them. But there are some books out, and I would just Google them, that are called things like financial statement analysis, or financial statement analysis for investors. And just Google something like that, and they tend to have provide a good resource where you don't have to be an accountant, but it'll sort of point you to the important parts of the financial statements that you need to use for financial analysis.
All right, our third question is, what are your thoughts on cryptocurrency?
Well, my own thoughts is I don't trade in cryptocurrency, so it's a good idea for somebody to come in, because in my view, I'm more of a fundamental investor in companies, and it'd be good to have somebody who's an expert on cryptocurrency come in to speak with it. I think it as highly speculative and an investment that doesn't necessarily lend itself to fundamental investment analysis in the same way. So I'd have to punt the answer to that question, but that's my view. Is it's a bit speculative, but I have friends who invest and they swear and they've sworn by their investments.
Our next question is, do you believe short-term trading, such as day trading and swing trading, can consistently be profitable?
I think it can. I know people that have consistently made earnings off of day trading, but I've also known people that have made money for a period of time, and then the world falls apart along the way too. I fundamentally believe that the best way to make money in the stock market is investing in a highly diversified portfolio of companies that you think are going to have long-term growth prospects and letting them work for a period of time where day trading is really trying to profit off of the daily volatility of the stock market. And in the end, I think that's hard to read for most of us, and hard to accurately predict the outcome. So I'm not I would not become a day trader, but I know people do make a living at that.
Our next question was, is there anything to be gleaned from PE or PB figures without comparing other similar companies? Like, for example, is high PE good or bad?
Well, high PE, you really have to compare it to the market as a whole and other companies usually within the same industry sector, and then understand them, because it isn't necessarily good or bad. Usually, if a company has a higher PE ratio than another, it's usually because there's an expectation of, it's one or two things. They believe that the earnings growth is going to be very stable and managed, or there's going to be very high growth prospects over time. And that's what the market's telling you by being willing to pay more for a dollar of earnings than the other. I'm either buying growth or I'm buying stability of earnings. But you're usually comparing that multiple to another company. Like in this case, I might want to compare the Clorox Company to Procter and Gamble or another big consumer products company, and see how those are trading. We in my business, where we're often buying private companies, and we were looking at, in effect, kind of the equivalent of a PE multiple, we always compare those numbers to other businesses in the same company, like public companies and so forth, to determine whether that value made sense to us. And PB would be the same thing. PB is probably less of a relevant metric in companies like Clorox, they're consumer products companies, because you could get these astronomical price to book ratio, because this company is really trading more off of its high profitability than it is off of its book value. Price to book is probably much more relevant in companies like large banks and financial institutions, where the balance sheet is sort of a critical part of the financial analysis.
We had a question asking, would it be a good idea to invest in startups and getting more equity, or buying stocks of a stable and well-known company?
Well, the challenge with startups, and I invest in both, and I'm involved in a lot of startups, is, and my answer to that might be both. But if you're only going to invest in one, I would invest in a diversified portfolio of stable companies. Problem with startups is there are many, many factors that are going to affect your ability to realize gains or value out of that investment. It is, for instance, a startup, you have to look to, oftentimes these are based on technology or a type of proprietary knowledge or something. Two, they're usually unexecuted at that time, so you don't know whether the company can bring the product to market. Three, the market is untested, so it's not clear what the demand for that product is going to be down the road. Four, it's not clear that that management team is going to be an effective management team and willing to stick around for that company for the long run. So there are a lot of risk factors. Oftentimes we go to a startup and say, hey, my friend's got a great idea. Listen to this idea. This doesn't sound like the greatest idea in the world. I want to invest in it. But the things that may affect the success of that company, there are many variables that will come into play that can cause that company to either underrealize its potential or or even fail along the way, so that the risk is very, very high. Now, when you're young, and if you don't need the money, investing in a few startups and to try to get it big may not be bad. But if you do invest in a startup, don't invest just in the idea. Invest in, make sure you understand the marketplace, make sure you understand the competition, make sure you understand how well protected the intellectual property is in there, and make sure you know that management team can execute. I invest, I'll tell you, I invest in both, but my investment in startups is a very small piece relative to my investment in the broader market.
What are your thoughts on using dividends to compound your portfolio's value?
Using dividends, you mean to just reinvest?
Yeah.
Yeah, I mean, dividend stock, the advantage of a dividend stock, companies that pay dividend, like the Clorox Company, I forgot to mention that, but you can see they have a high dividend ratio, meaning they pay a lot of their income out in dividends to shareholders. One is, if that money's coming out of the company to the shareholders, that's an element of financial value that is easy to value, and it really stabilizes the stock value quite a bit. And I would tend to, in all of those situations where I have an investment in a portfolio of dividend stocks, reinvest those. And oftentimes your broker will do that automatically, where you tell your broker, I want to be in a dividend reinvestment plan. So if Clorox sends me $1 of dividend, I want you to convert that into a share of stock every time they pay a dividend. So I think dividend reinvestment is a good idea.
We had a question that came in. It said, when a company goes out of business and all the money is liquefied, do the debts go to bond owners and to contributors directly before tax, and then the shareholders get them?
Yeah, so there's a hierarchy. If you go into bankruptcy, there's a set of rules that determine who gets what in that bankruptcy. And if you don't have, so what they'll do is liquidate all of the assets and turn those to cash eventually. Then they'll turn around and they'll say, bankruptcy rules say certain people get certain things. So first people to get paid generally, I'll generalize on this, but if employees are unpaid, they tend to get paid first. So if you didn't receive your paycheck, then you'll get paid first. Then the next group to get paid is usually secured creditors. So security means that you've borrowed money, but you've said to the bank that you borrowed the money from, you will have first claim on any assets before any other creditors. So you pay off any secured creditors that have a security interest. Then after that, general creditors will get paid. And that could be anybody, like the person, you bought some raw materials to make your product and you didn't pay for those raw materials. So that's a general creditor there. Or, you bought a service from somebody and you didn't pay for that service. That's a general creditor. So general creditors, or just unsecured debt. So general creditors would be roughly the third group in line. Then after all the general creditors are paid off, anything else would be distributed to equity holders. Now, companies can have more than one form of equity, and you can even see it in Clorox balance sheet. You could have what's called a preferred equity and then a common equity. If you have a preferred equity there, that usually means that level of equity gets paid before the common shareholders. So if you buy preferred stock, you get a credit preference. If you buy common stock, you are the lowest person on the totem pole to get paid out in liquidation. But the common stock in a successful situation gets the highest yield out of the growth of the company. So you're worse off with common stock in a liquidation. You're best off in the successful growth of the company.
What are your opinions on SPACs and special acquisitions right now, since they're being so profitable?
Well, it's hard to tell whether they're profitable. They are very successful. They're very popular at this point in time. And I do think, to a large degree, what they are is a very efficient way of bringing public equity to to maybe private companies. So, and a SPAC, Special Acquisition Corporation, it's usually set up by a private equity firm who says, I'm going to go out and buy some companies. So I'm going to create a public company. I'm going to have a bunch of people buy stock in that company. And when they buy stock, they're going to give me cash for that stock, and that stock will trade. And then that company is going to go out and buy other companies, usually companies that are now private. So it's a very quick way of making a private company a public company by setting up the public stock vehicle in advance and then going out in search of companies. And I haven't followed SPACs as close as others. I would watch them fairly closely though, because in the end, they're usually set up by a private equity firm, and the structures can be more advantageous to the company that set them up than they are to the company that the people that invested in them. So I think you just have to know and understand what you're buying into.
What would you say are some of your favorite fundamental stocks that you recommend when starting a portfolio, just as like a base?
Well, I would, frankly, if you're starting a portfolio, my recommendation is, and if you want fundamental stocks just for long-term growth in your portfolio, I would not go and pick individual stocks. I would go and pick, I would instead go to very low cost index funds or ETFs that are based on broad market. So you can go and buy a S&P 500 index fund or ETF where the fees are very low to be in that fund, but you get a very, very broadly diversified portfolio. So if you want a broad portfolio for long-term growth, invest in something like in broad-based index ETFs. Then on the other question is, if you're going to be a stock picker, it's almost impossible, for me to sit here now and tell you which individual stocks to pick, because it sort of changes over time based on what we were just describing here, which of those companies have the greatest prospects for growth at this period of time relative to where they're priced today. And in that case, I think the best way to go about it is read the book that says How Wall Street Works, and it'll show you how you can go through the current market today, pick the stocks you think are undervalued and have the criteria that you're looking for, and build a portfolio out of those. So without telling you which individual stocks, I would recommend you use one of those approaches where they show you tools where you can go out, evaluate the current stock market, who seems to be undervalued, and which stocks should you go into. Now, you have to remember about that those approaches is they're not about picking one or two stocks for fundamentals. They're about building a portfolio of 20 to 50 stocks, so that because if one fails, the rest of the portfolio may perform very well. So having that diversification of your investment among a lot of companies is a critical part to maintaining long-term growth with safety. Buying individual stocks is always at risk because even the best company can be hit by an unexpected surprise and cause that stock to undervalue. And if you put all your money in a single stock, you're at risk of losing a great deal.
That seems like all the questions that were asked in chat. If there's any more, feel free to leave them, but I believe we'll be ending the meeting soon. All right, well,
I appreciate you including me. It's been an interesting time to meet everyone, and I applaud you on your interest to start at a young age to learn about the investment world.
Yeah, and we appreciate you helping us.
Yeah, happy to do it.
Well, that has been all. Thank you, everybody, for attending.
All right, thank you.
And everybody have a good day.